Here's the counterintuitive part. When the world feels most dangerous, gold usually goes down first, not up and down. And the people who understand why that happens, the mechanical reason, not the emotional one, are the people who've historically had a chance to be in the right place before everyone else figured it out. The people who don't understand it sell at exactly the wrong moment, feel smart for about 3 weeks, and then watch the thing they sold go to new highs without them. I'm going to explain that to you today. Simply the way I'd explain it to my grandchildren over breakfast. No charts you need a PhD to read. No jargon that makes you feel stupid for not already knowing it. Just the honest pattern, why it repeats, and what a patient, careful person might want to study. Right now, let me start with a problem, because I think most of you watching this know this, feeling very well. You bought something, maybe gold, maybe silver, maybe a mining company, because the world looks scary and gold is supposed to protect you when things get scary. That's what everyone says. That's practically the whole pitch, safe haven store value, ancient money. And then the scary thing actually happened, and your position went down, maybe a lot, and you sat there staring at it thinking, I did the right analysis. The world is genuinely on fire. Why in the world is this going the wrong direction? That feeling is one of the most common experiences in investing, and almost nobody explains it properly. Instead, what you get from the financial media is noise. Either they tell you gold is finished and you are a fool for buying it, or they tell you to hold on because it's going to the moon any day now. Neither one of those is actually useful. Neither one tells you the mechanism. And without the mechanism, you're just guessing. Guessing with your savings is not a strategy I'd recommend. I've watched thousands of investors over my career, not just the institutional ones, but regular people, farmers in Nebraska, shop owners in Ohio, teachers saving for retirement. And the pattern I see most often is this. They buy things when they feel confident about them, which usually means prices are already high. And they sell when things get uncomfortable, which usually means prices are already low. It's perfectly human, and it's also perfectly backward. And understanding why gold drops in a crisis is the first step to not doing that backward thing ever again. So let me walk you through this simple mechanical sequence. It isn't complicated once you see it. It's like understanding why the tide goes out before a wave comes in. Once you know the physics, you stop being surprised. Step one, something frightening happens in the world. A war, an oil shock, a financial disruption. Doesn't matter exactly what. The important thing is that it's the kind of event that makes people nervous about tomorrow. Step two, oil prices go up or are expected to go up because most of the world's big disruptions happen in or around the places where oil comes from. And when oil goes up, people start worrying about inflation, not actual inflation, yet that takes time to show up in the grocery store. But the expectation of inflation, and in markets, expectations move faster than reality. Always have. Step three, the Federal Reserve, seeing those inflation expectations rise, can no longer do what markets were hoping it would do, which is cut interest rates. The Fed freezes. It has to. Because if you cut rates when inflation fears are rising, you're basically throwing gasoline on a fire and hoping it goes out. Step four, when the market realizes rates aren't going to fall, bond yields go up. Now, bond yields are just the interest rate the market itself sets on government debt. Think of it this way. If the U.S. government is going to pay you 5% a year to lend it money, and it's backed by the full faith of the United States Treasury, that starts to look pretty attractive compared to gold, which pays you exactly nothing and just sits there. So big institutional money pension funds, sovereign wealth funds, insurance companies, they move toward that guaranteed return. Not because they love bonds, just because 5% in hand is 5% in hand. Step five, all those investors moving into U.S. bonds have to buy U.S. dollars first. And when everyone's buying dollars, the dollar gets stronger. And here's the kicker. Gold is priced in dollars. So when the dollar strengthens, gold looks more expensive to every investor outside the United States, which means foreign demand drops and the price of gold in dollar terms falls. You get three things hitting gold at exactly the same time. Higher yields competing for attention, a stronger dollar making gold expensive, and institutions selling gold to raise cash or lock in profits they'd already made. It's like a three-way headwind, and it happens in some form almost every single time. That's it. That's the whole mechanism. Not complicated, but most people never hear it explained that plainly. Now let's look at history. Not an academic way, just the way you'd tell a story at a kitchen table. October 1973, OPEC cuts oil production and puts an embargo on the United States. Oil prices do something nobody thought was possible. They quadruple almost overnight. And gold drops, and then it starts to climb over. The following months, it goes on one of the most significant runs in its history. The people who understood the sequence, the people who knew gold was going to get whacked first, had a chance to be patient and position. The people who panicked and sold near the bottom watched the whole thing happen without them. Iranian Revolution, oil production collapses, prices go to the moon. Gold initially does very little, and then over roughly the next 12 months, it goes up somewhere close to 90%. 90%. And I'll tell you something, most of the people who captured that move weren't geniuses. They just understood that after a shock, there's always a delay. The world takes time to process what's happened. And patient money sits in that delay. Then you have 2001, September, the kind of day nobody forgets. Gold was around $270 an ounce. Over the following decade, it went to nearly $1,900. Not a straight line. Nothing ever is. But the direction was unmistakable once you understood the structural forces involved. Debt was rising, dollar confidence was quietly eroding, central banks were beginning to think differently about what they wanted to hold in reserve. Ukraine and Russia in 2022, same pattern, different costume. Oil disrupted, inflation expectations spiked, the Fed froze, then raised rates, gold got sold down, then it broke $2,000 for the first time and kept going. Every one of these, every single one, the pattern is the same. Gold drops first, then it recovers, then it goes to new highs, not because anyone predicted it with certainty, but because the underlying forces are real and they don't change just because the headlines do. Now, I'm not saying the past guarantees the future. It doesn't. Any person who tells you they know exactly what gold is going to do next is either lying to you or lying to themselves. And I'm not sure which is worse. But when you see the same mechanical sequence repeat across 50 years and half a dozen different types of crises, it deserves your serious attention. Let me tell you about where we are right now, because I think the situation is genuinely unusual and not in a hype-filled, breathless way, in a quiet, this deserves careful thought kind of way. Gold ran up to extraordinary highs earlier this year, and then a significant conflict broke out in the Middle East. Oil disrupted. Inflation expectations moved. The Fed got stuck, and gold dropped substantially, 20% from its highs, roughly. And the headlines did exactly what headlines always do. They declared gold finished. The trade is over. You missed it. Move on. I've been around long enough to know that when the financial press reaches a near unanimous conclusion, it's worth slowing down and asking whether they might be wrong. Not always, but often enough that the reflex is valuable. Here's what's different this time. And I want to be careful not to oversell this, because I genuinely don't know what markets will do in the short run. Nobody does. But the structural factors underneath gold are, by almost any historical measure, more supportive than they were in any of those previous episodes I just described. The United States is carrying roughly $36 trillion in debt. In 1973, when OPEC first shocked the world, that number was around $500 billion. I don't say this to alarm you. I say it because it matters for something called the credibility of the dollar. The more debt a country carries, the more it has to pay in interest, and the more that interest crowds out everything else: defense, infrastructure, social programs. The government is currently paying more in interest on its debt than it spends on its entire military. That is an extraordinary sentence to have to say out loud. And I'm not sure most people have really absorbed it. Central banks around the world have been quietly changing their behavior for decades, literally decades. Central banks were net sellers of gold. They were getting rid of it, moving into dollar reserves, euro reserves, other instruments. That changed a few years ago and has continued. Central banks, taken as a whole, have been buying gold at a pace we haven't seen in a very long time. These are not emotional buyers. They are not watching YouTube videos or reading financial newsletters. These are the largest, most deliberate pools of capital in the world, and they are slowly, methodically adding to their gold reserves. Now, you might ask, if the structural case is so strong, why did gold drop so sharply? And the answer brings us back to the mechanism, the short-term forces I described, the bond yields, the dollar strength, the institutional selling to raise cash. Those are real and powerful in the near term. They override the structural story for weeks, sometimes months, but they don't override it forever. The short term is loud, the long term is quiet, and quiet usually wins. There's a simple technical marker that almost every major institution tracks, called the 200-day moving average. Think of it as the long-run trend line for a price. When an asset is trading significantly below that line, it historically has represented, not always, but historically, a moment where the selling has been exhaustive and the patient money starts to look more seriously at getting in. Gold is currently trading at a meaningful discount to that line. The last time it was this far below it, the subsequent move was substantial. And I'm not going to give you a number, and I'm not going to promise you anything, because I can't and I won't. But I will tell you, it's the kind of thing worth studying. Now, I want to talk about something beyond just owning gold itself, because I think there's a category of investment that many people overlook when they think about gold. When gold prices are high and the cost to produce an ounce of gold is fixed, or at least rises much more slowly, the companies that dig gold out of the ground can make extraordinary profits. It's a form of leverage that is built into the business model. If a mining company can pull an ounce of gold out of the earth for $1,400 and sell it at $4,300, the profit on that ounce is nearly $3,000. That's a margin most businesses would find unimaginable. And when gold prices rise further, that margin gets wider, and the earnings of those companies grow much faster than gold itself. I've always liked businesses I can understand completely. Gold mining, at its core, is pretty simple. You find the gold, you dig it up, you sell it. What you have to look at is how competently they find it, how efficiently they dig it, and how well they manage the costs in between. These are knowable things. They're in the financial statements. They can be studied. Let me give you a few names worth looking into. Not buying, looking into. There's a difference, and the difference matters a lot. The first is Agnico Eagle Mines. The ticket is AEM. This is one of the larger and more established gold producers in the world, operating primarily in politically stable jurisdictions. Canada, Finland, Australia. That matters more than people realize. A mine in a stable country is worth more than a mine with higher reserves in an unstable one, because you can actually count on getting the gold out. Their cost to produce an ounce is around $1,400, give or take, depending on what you include. With gold where it is, they are printing money, their revenues have been growing, their margins are expanding. It's not a complicated story. It's a company that digs something up for one price and sells it at a much higher price, and the gap between those two numbers is getting wider. Now, I want to be honest about what I don't know. Mining is not without risk. Things go wrong underground. Environmental regulations change. Politics shift. Costs rise faster than expected. These are real risks, and any honest assessment has to include them. I'd encourage you to read their annual reports, look at their cost history, and understand their reserve base. But as a business at current gold prices, it's the kind of thing I'd want to understand more deeply. The second is Franco-Nevada, ticker FNV. This one's a little different, and I'll confess it's the kind of business model I find rather elegant. And Franco-Nevada doesn't actually mine anything. They provide financing to mining companies in exchange for royalties, a percentage of everything that company pulls out of the ground for the life of the mine. It's a bit like being the landlord instead of the farmer. The farmer does all the hard work, faces all the weather and the broken equipment and the difficult seasons, and you just collect a portion of the harvest. Your costs are low, your downside is limited, your upside participates when gold does well. Their revenue growth has been exceptional. The business generates cash, and there's something inherently sensible about owning a royalty rather than a shovel. The third is Wheaton, Precious Metals, ticker WPM. Similar business model to Franco-Nevada. They're a streaming company, which means they provide upfront capital to miners in exchange for the right to purchase a fixed portion of production at a predetermined low price. Wheaton then sells that metal at market prices. When gold and silver go up, the gap between their purchase price and their selling price gets wider, and their earnings go up substantially. It's again a form of leverage without the operational complexity of running a mine. The numbers have been strong. Their cash generation has been consistent. It's a business that's been around long enough to have a track record. You can actually study. I'm not telling you to buy any of these. I'm genuinely not. What I'm telling you is, if you want to understand gold's potential, start by understanding the businesses that benefit from it in a leveraged way, and do so with the same rigor you'd apply to any other investment. Read the annual reports. Understand the balance sheets. Know what you own before you own it. I want to take a moment and say something about the index fund question, because I know a lot of people watching this keep most of their savings in index funds and feel comfortable with that. And I understand why. For a long time, it was an excellent strategy. Broad diversification, low cost, participation in economic growth. But here's what I think is worth understanding, and I'll say it simply. An index fund is only as good as the underlying index. It tracks the S&P 500, contains 500 companies, but the performance of that index in recent years has been driven by a very small number of them, sometimes as few as 10 or 15, while the rest have lagged or declined. So when you own the whole index, you are partly owning those winners and partly owning a much larger number of companies that are diluting your returns. You may feel diversified, and in one sense you are, but in another sense, you're carrying a lot of weight that isn't pulling for you. That isn't an argument to panic or sell. It's an argument to understand what you actually own. And if you understand it and are comfortable with it, wonderful, keep going. But knowing the difference between feeling diversified and being strategically positioned is worth the time it takes to learn. Now, I want to bring this back to the central lesson, because I've found over many decades that if you don't say the important thing clearly and say it more than once, people remember the window dressing and forget the furniture. Here's the thing I want you to walk away with today. Gold's behavior in a crisis is counterintuitive, but it's not random. There is a mechanical sequence: shock, oil, spike, inflation expectations, Fed pause, bond yields rise, dollar strengthens, gold sold. And that sequence is repeated after every major crisis in the past 50 years. Understanding that sequence doesn't tell you exactly what will happen next. It tells you why what just happened makes complete sense. And it puts you in a position to think calmly about what has historically come after. The people who make drops in a crisis, the thesis isn't broken. The mechanism is running its course, and knowing the difference is worth a great deal. There's one more thing I'd like you to sit with, and it's something I've thought about often over the years, not just in relation to gold, but in relation to investing generally. The market is very good at making the right thing feel uncomfortable. That's almost a design feature. When gold is at its most attractive, when it's been sold down, when the headlines are terrible, when the institutions are still cautious, that's precisely when it's hardest for a human being to step forward and say, I think this represents a good opportunity worth studying. Because everything around you is telling you to be afraid. The news, your portfolio balance, your neighbor's opinion, the feeling in your stomach when you look at the red numbers. But here's what I've observed over and over again, going back to when I was a young man, buying stocks during periods nobody wanted them. The feeling of discomfort and the presence of opportunity are often the same thing, wearing different clothes. Not always. You can be wrong. I have been wrong, and I'll be wrong again. But if you wait until the comfortable moment, until gold is back at highs and everyone agrees it's a great asset, you've likely missed most of what was available on a stand on. Thank you for listening. Be careful with your money. Be patient with your decisions. And remember, in investing, as in farming, most of the work happens before the harvest. The people who plat in the uncomfortable seasons are usually the ones who eat well in the good ones. Take your time. Do your homework. And don't let the noise rush you into anything or out of anything before you've had a chance to think.